Hello and welcome back to the Rational Investor. I hope you guys are enjoying your day. Today I'm going to give you some pro tips on why I don't own JEPI, JEPQ, or TSLY anymore and got out of all of them. So stick around, I'll get into the details and we'll go from there. Good morning. My name is Adam Kahn and I'm the Rational Investor. I hope you guys are all doing well. Today is Wednesday, December 20th. I'm going to talk a little bit about JEPI, JEPQ, TSLY a little bit. I'll mix that in and explain why I don't own them. But as I get into it and before I get into it, do me a favor if you haven't already, hit the subscribe button, hit the like button. I really appreciate the help. That helps YouTube's algorithm so other people find the channel. And if you guys are enjoying the content, it allows them to enjoy the content as well. I can't tell you how excited I am to see how the channel's grown. We're up to 2,000 subscribers, and I can't thank you guys enough. Like, really, to be perfectly honest, I do this because I like markets and it gives me an outlet, so I enjoy doing it. Um, but seeing the channel grow is just kind of cool. So again, thanks. I do appreciate it. I'm also going to put a link in the description on how to open an account at SoFi. I own stock in the company and I also opened an account myself there. I linked the account that I opened with the one that's the link in the description. If you guys deposit $10 or more, they're going to give you a free $25. And when I clicked on it and played around a bit, there are also other ways. I think they can give you up to $275 if you do other things, but don't hold me to it. You'd have to play around a bit. The other thing is it gives the account that I opened a little bit of a gift. It's an account I did with my son. He's 13 years old. Really, I try to teach him about investing and saving and things like that. And since I'm his dad, he doesn't always listen so much, but when something gets put in that account, he gets excited and it helps him to pay better attention. That's what I appreciate out of it. So let's talk about these stocks and the things that I don't like about them. But before I get into it, understand this is not financial advice. You guys need to seek your own financial advisor and make your own financial decisions on what works for you. Every investment strategy has a reason that it gets used and fits different people for different reasons. And just because it doesn't fit me doesn't mean that it doesn't necessarily fit you. So I don't want people to get the wrong idea. I primarily am doing this because I got a lot of pushback because I know a lot of people really like these funds. My concern is that they're getting attracted to yield, and it would be what I would call a bit of a yield trap. Like, odds are it's not going to perform as well as the underlying equities. And as I continue, I'll get into that and explain it to you guys. So what JEPI does is they use S&P 500 stocks and they get long them on I think up to 80% of the money invested in it. And then they also use something called an ELN, which is a equity linked note, if I remember the words right, that they use against it, and they might sell calls on the equity linked notes. The problem is, essentially what they're doing is they're getting long the market, and JEPQ does a really similar strategy using the NASDAQ. They get long the stocks and they use this to essentially sell calls against it. Now, the ELNs over time have gotten really what they call opaque, where they're written specifically for the funds that are used them, and it's hard to know what's in them. They also oftentimes have really high costs to them. So, for all we know, and I do not know this is not me stating fact. This is just me making my hypothesis just from being in the industry for a long time, that they might be paying themselves some fees that so that they're not charging as high fees for the funds, if that makes sense, to make the note whatever the note is comprised of. Now, originally what these were made for is to essentially preserve equity and and help people from downside risk. But as they've evolved, it's changed to really match whatever a fund wants out of the ELN. And it's an ability to work a short term agreement. And my guess is, and again, just my guess, in JEPI and JEPQ, that's what they're using for their call covering strategy. What I don't like about a call covering strategy for the markets as a whole is you're going to limit what you make on the upside, and you'll primarily only do better if the markets go lower. So it's almost a bet the markets go lower, which is why I say I talk to your financial advisors about that. If that's a concern, there are ways to get protection from downside moves. Now, maybe the advisor you use doesn't use those strategies. Maybe they do. So that's why I say you really have to make your own decisions. At the same time, if I'm going to use a call covered strategy, at least for me personally, I'm comfortable trading calls. I'll look for weekly or monthly call options and start doing that on my own, because the one I like the least, which is TSLY, TSLY, they use a strategy that essentially, from what I was reading about it, takes on leverage and puts on a little bit more risk in order to get the returns they're getting, and they're giving really high returns. In general, the higher the return on something, whatever that something is, the more risk a company is taking. And the strategy that TSLY does is they sell an at the money put and they buy an at the money call to be synthetically long the stock. So what that means is I'll use a fake one instead of Tesla, because just for ease. So if a stock is trading at $100, they will sell an $100 put and they'll buy an $100 call. The put is kind of an insurance to the downside, but by selling it, if the stock goes lower, you're committing to buying the stock at $100. If the stock goes higher when you buy the call, it allows you the opportunity to buy the stock at $100. The reason for this strategy, instead of buying the stock outright, is leverage. What that does is, instead of having to, if you wanted to buy 100 shares of a $100 call, that would cost you $10,000. If you buy the call, it's a $100 call that's at the money. It's not going to cost you the full same price. So maybe it costs $2, $3, $4, $5, just depending on the volatility and everything else. So instead of putting out 10,000, maybe let's say it's $3. You're only putting out $300 to buy that call. And then if you sell the put, which has risk, and maybe you receive the same $3 for the $100 put, you really haven't put out any money yet. And then the trading firm that you're going through evaluates the volatility of the underlying stock and the short put to require you to have a certain amount of margin in case the stock goes lower. So odds are you don't have to put up a full $10,000. So let's say they make you put up $3,000 for that risk. Again, just making it up. It's not a real number. But that might be realistic, especially if doing weekly, that they figure a 30% move in 1 week is pretty extreme, and they'll continue to require you to put up more if the stock continues to go lower. Then they use some of the funds to buy treasuries or CDs or secure assets to get a little bit higher of a yield in the meantime. What they then do is they sell weekly call options a little bit out of the money to collect premium and get what they're sending out as dividends on top of the return from the treasuries. So, short the $100 put, long the $100 call. Maybe they sell an $105 call for an extra $1.50 to get what they're sending out in the dividend, and they do that on weekly options. One of the things that I heard the guy talk about who runs the fund is the other advantage he feels that gives is, if the stock falls, that gives them an opportunity to cover the 105 call and sell a lower call to get more premium. He even went into, that's why we call the fund yield max, because the goal is to give as much yield as possible. So what I don't like about that fund is it limits you to how far the stock can go up, because whatever call you sold, that's all you can make on the stock. And yes, you're getting the premium. It feels like a dividend. But in this scenario, if the stock falls, since you're short the puts, you have full exposure to the downside risk of that stock. The fact that they're selling calls and then lowering the strike prices, if it falls fast enough, you will collect some dividend because of it, but you're constantly going to be limiting how much you can make to the upside as the stock falls lower. So let's pretend for a minute the stock falls really badly and goes from 100 to 85 on the Monday of this example. Well, if they decide to then lower to a 95 call to get additional premium, they've essentially locked in the loss of what the stock has fallen, and made up some of it by the premium they're getting from selling the call. Again, I'm not comfortable letting somebody else handle my money like that. So I would rather be in control of it and manage it myself or not have that type of strategy. That doesn't mean it doesn't work for you guys. That doesn't mean you guys shouldn't do it. I got a lot of pushback from a lot of people who liked these funds. I just don't like that type of risk. And I don't think a lot of people buying these funds really understand the risk they're taking. I think they're getting attracted by the yields and they think that's return. And they don't really understand they're actually long the stock and just limiting upside potential. And, you in some ways, I guess if the stock falls, you're going to lose less than somebody who just owns the stock outright. But you still have most of the risk to the downside, which is why I don't like TSLY in particular. JEPQ, JEPI, they're a bundle of S&P and NASDAQ stocks, and they're a little bit more secure from what I was seeing in it than I would feel like is the yield max funds. But I still don't love those strategies either, depending on how long you're hoping to be in the market and what your goal is. If you're worried about downside risk, it will make up some yield as the markets fall. But similarly, as the markets fall, they're going to be selling lower calls and kind of limit your upside by more and more if it goes lower. If you're curious, I do a video every Sunday on an account that I opened that I put $10,000 in. When I got out of JEPI, JEPQ, and TSLY and my other accounts, I do have 10 shares of JEPQ in that account as well. I bought 20 different stocks that I put $500 in. You can watch and see how it is performing against the other stocks. And to be fair, we've had a huge bull run and it is not performing as well as most of the other stocks in that account. And if you're curious, I plan to do it every week. I'm curious too how it plays out over the next 6 months, year, 2 years. I even watched another video who went over the math of how I think he used JEPI, how it had performed over the past 2 years against the S&P 500. And it did not do nearly as well. Now, again, I'm guessing, I don't remember the exact numbers, but I want to say that JEPI, even with the dividends, made something like 14% return, which is just fine. But the S&P 500 had done 30 or 40% return, so it had lagged significantly. So that's my main concern, is that people are getting attracted to the yields and not about the growth of the stocks. And in the long run, wherever you make the most total money is the best place to be. Now, again, you guys need to make your own decision. I'm sure that these funds fit people wonderfully, and there are plenty of people. These are good investment tools to be using. I was just saying, for me personally, these are not the things I'd like to use. I'm totally comfortable trading my own accounts, and I got kind of asked that somebody said, "Well, do you trade?" I have different accounts for different purposes. I put the bulk in some. Essentially, I'll ask for the stock certificates for the most part, and I throw it in a safe deposit box. I don't trade it. I don't watch it. I mean, I keep an eye just because I keep an eye. But there's certain companies I just want to own, and I want to own them for the next 5, 10, 20 years because I know the sooner you buy it and the longer you leave it in over time, the better you do. If you guys are curious, I'll be happy to do a video. Let me know, and I'll tell you what stocks I do that with. I have another account that I keep that's primarily dividend stocks that I leave in an account so I can move that money into my checking account and be able to use that accordingly. And then I keep a small account that I like to trade. Um, and then the one account that I opened up for YouTube just to show you guys that investing is not a scary thing and that it doesn't move as much as people often expect. Um, I like to pat myself on the back. Timing couldn't have been any better. I've been so lucky with that account because this past month, the stock market has, what did somebody say? The past month has been a great year. They said, the stock market had a great year this last month, which is really true. I mean, there are a lot of things that are up a ton. So anyway, that's why I don't personally want to own JEPI, JEPQ, or TSLY at this moment in my life. Maybe in the future there'll be a spot in my portfolios for them. but I'd feel more comfortable with the financial advisor I use and letting him sell some covered calls against some things in the portfolio than using those products. So again, before I forget and before I go, I hope your day's going well. Don't forget to subscribe. My God, if you made it this far, say something. I'd be so thrilled. I would love to hear it. Give a thumbs up and stick around for my other videos. I really appreciate you guys being around. Have a great rest of your day.